Hello, welcome everyone. Today we are discussing chapter 3 for the managerial accounting, job order costing, cost flow, and external reporting using a book, Introduction to Managerial Accounting, and editions by McGraw-Hill. Okay, let's look at the first one. What are the vocabulary terms that are being used in this particular chapter? Number one is job order costing, which is a costing system used in situation where any different products, job, or services that are produced in each period. Okay. What is absorption costing? It is a costing method that includes all manufacturing costs, direct materials, direct labor, and both variable and fixed and manufacturing overhead in the cost of a product. Okay. What are the allocation base? It is a measure of activities such as direct labor or machine hour that is used to assign costs to cost objects. What is predetermined overhead rate? It is a rate used to charge manufacturing overhead. It is a rate used to charge managing overhead costs to jobs that is established in advance for each period. It is computed in the following logic, which is the predetermined overhead rate here equal to the estimated total managing overhead cost divided by estimated total amount of allocation base. Okay, what are the overhead application? It is the process of assigning overhead cost to a strict job using the following formula, which is overhead applied to particular job or predetermined overhead rate multiplied by amount of allocation base incurred by the job. Okay, the normal costing is a cost system in which overhead costs are applied to a job by multiplying predetermined overhead rate by the actual amount of the allocation base incurred by the job. What is job cost sheet? It is a form that records the direct materials, direct labor, and overhead costs charged to a job. Okay, those are the terms being used for this particular chapters. Learning objective 1 is understanding the flow of cost in the job order costing system. Learning number 2, using a T count to show the flow of cost in the job order costing system. What are the key divisions in the flow of cost? Number 1 is the raw materials, which include any materials that go into the final product. Number 2, work in process, which consists of unit of production that are only partially complete and will require further work before they are ready for sale in to customer. Number 3, finished good consists of completed unit of product that have not been sold to customer. Number 4, cost of good manufacturing includes the manufacturing costs associated with the goods that were finished during the period. What are the flow of costs? Conceptual overview. This is all the raw materials, which is all the product cost. It consists of raw materials, direct labor, and machine overhead. It goes to the balance sheet in terms of the materials inventory. Okay, go into the direct material used in productions. Go work as a work in process inventory. Example: raw materials as flour to make samosa, which you're gonna create to make samosa. We're gonna work in process. Once the samosa is compact, and then fried, it's gonna be finished good inventory. Okay, that is gonna be your cost of goods sold. And then selling element expense here as a selling element expense into the income statement here. Okay. So the manufacturing overhead, such as other costs like labor and etc., it's going to be considered as a work in process as well. Okay. To illustrate here, example, Rogers has for the April month worked to create producer a gold and silver community form on a two job. Okay, there's two job here. Job A, special mining 1,000 gold medallion, commemorating the invention of motionless pictures, started during March, completed in April. As of March 31st, Job A had assigned 30,000 manufacturing costs, corresponding to Rogers' work in process balance is 30,000. Job B, an order of 10,000 silver medallion, commemorating the fall of Berlin Wall, which started in April and completed at the end of the month. Example in the T count here, raw materials, direct materials, and indirect materials go all the way to work in process and the job cost sheet, while indirect materials will go to manufacturing overhead here. Okay, this is the way it goes in the T account. Let's go to the purchase of raw materials. Example, Rogers Company had 7,000 in raw materials on hand during the amount The company purchased an account additional 60,000 in raw material, which is how you're going to book it. Raw material is 60,000, debit, account payable, credit is 60,000. Issue direct materials during April account requisitions. How you gonna book it? Withdrawing is 50,000 here. Okay, in raw material from store account, this material includes 50,000 in direct materials and 2,000 in direct materials. How are you gonna book this? Work in process is 50,000 debit. Manufacturing overhead debit is 2,000. Raw materials credit is 52,000. Okay, let's look at the next level. In terms of the T count, direct labor go to the direct labor here. Indirect labor go to the manufacturing indirect labor here. Okay, that's the T count process. And then in April cost, again, employee time ticket hourly includes 60,000 recorded direct labor and 15,000 for indirect labor. So how are you going to book that? Work in process 60,000 debit here for labor, manufacturing overhead 15,000 debit, and then salaries and wages payable, which is total of them 75,000 credit. So that's how you're gonna book that in your logic. Okay, so let's look at the next one. The T account. All here salaries, wage payable will consist of direct labor and indirect labor. Work in process called direct labor and direct labor here. Direct materials for direct labor. Manufacturing overhead consists in indirect materials and indirect labor because it's overhead. Okay, other overhead, that's the one. And then look at the next one. Assume Ruger Corporation include the following factory costs: utilities 21,000, rent factory 16,000, mission factory overhead 3,000. Total, all of them is gonna be 21 plus 16, 37,000 plus 3, 40,000. So how you gonna book that? Manufacturing overhead debit 40,000, account payable credit 40,000. So when you do that, you're gonna put management overhead on the credit side, applied overhead work in process, book it under work in process, move it here to the debit side. That's how you're gonna, what is the applied and the actual. If actual and applied management overhead are not equal, a year-end adjustment is required. So that's how you book it in the T account. Okay, assume the Rogers Corporation's premium overhead for job A is and 5,000 machine hours. Okay, here. Corporation pre-determined overhead rate is 6% per hour. Assume that during April, 10,000 machine hour work on job A and 5,000 machine hour work out on job B. So a total of 15,000 machine hours. So total is 90,000 overhead costs, 6%, $6 per machine hour times 15,000. So how are you going to get that? $6 is predetermined here. And then you got 15,000, which is from 10,000 plus 5,000, you got 15,000. There, so your total you got 90,000. How are you gonna post this? Work in process is 90,000 debit. Matching overhead is credit is 90,000 there. Okay. Example: non-management costs that are assigned to individual. Example are salary expense of employee who work in marketing, selling, and artists. Are expensed in the period incurred. Depreciation expense on office equipment is expensed in the period incurred, and advertising are expensed in the period incurred. These are example non-manufacturing costs that are not assigned to individual job rather than expense in the period incurred. So how you gonna post this? Example here: salary expense include 30,000 in selling annual cost, salary cost during April. So you're gonna book salary expense debit 30,000, salaries wage and payable 30,000 credit. So its depreciation on office during April was 7,000. Identity is follows. Okay, so if there's a 7,000, so you're going to put depreciation expense posting debit and the accrued depreciation 7,000 credit. So that's how you're going to post. So these two shows you how you're going to post in the journal entry. Okay, these two example. The third one. Advertising was 42,000 and other selling expense 8,000. So how you gonna book it? Advertising expense debit is 42,000. Other selling expense 8,000 debit. So account payable credit is 50,000. You combine both. So what happens here? cost of good manufacturing and the job cost sheet is manufactured here, credit. And going into the cost of finished good, cost of good manufactured here, debit. Okay? Alright. Job A completed during April and job B was incomplete at the end of the month. Falling into the transfer job A work in process to finished good. So how are you going to book it? Finished good is 158,000 debit. Work in process 158,000 credit. Because job B was not completed by the end of the month, it is assigned, will remain as work in process and carry over the next month. If balance sheet were prepared at the end of the April, the cost of accumulated thus far on job B, 70,000, would appear in asset account work in process. Okay, so you're going to look at the T account. On the T account, it's going to be cost of goods sold here. On the credit side, it's going to be cost of goods sold here on the debit side. Okay, excuse me. Look at the next one, which is transferring finished good to cost of goods sold in terms of journal entry. Okay, assume 750 of gold, 1,000 gold made in job A. It was shipped to customer by the end of the month to total sales revenue of 225,000. Because 1,000 units were produced and total gross job from the job cost sheet is 158,000 and unit product cost was 158. Okay, so you assume this one. So how are you going to book it? The following journal will record it. Okay, account receivable 225,000 debit, and then sales 225 credit. Now, because 1,000 units were produced and total cost of the job cost is 158,000 and the product cost is 158. So cost of goods sold is 118,500 debit and finished good is 118,500. Okay. All right. Let's look at the objective number 3. This is prepare schedule of cost of good manufacturing and cost of goods sold in an income statement. So how are you going to go about this? Is the schedule contain 3 types, okay? Direct materials is number 1. Number 2 is direct labor. Number 3 is manufacturing overhead. The schedule calculates the following: cost of raw materials and direct labor used in production and the amount of manufacturing overhead applied to the productions. And then number 2, manufacturing costs associated with goods that were finished during the period. Okay? Alright, let's go into the next one. Product cash flow. Raw material purchased during the period were added to beginning raw material inventory. The ending raw materials is deducted, arrive at raw materials used in the productions. The item then removed from raw materials inventory and placed into the production process, they are called direct materials. Okay? And then, where do you gonna go about? This is how you're gonna go about. Direct raw materials plus raw material purchase equal to raw materials available for use minus ending raw materials called the raw materials used in productions. All the way here, go to managing cost of direct materials. Okay? And then direct labor used in production minus cost overhead applied to production are added to direct materials to arrive at the total manufacturing cost. So this is how you're gonna go about in adding it. Direct materials plus direct labor plus manufacturing overhead applied, so it will be total manufacturing cost. Okay, this total manufacturing cost gonna go all the way to work in process from beginning year plus total manufacturing cost. You're gonna go into total work in process for the period. So minus work in process inventory equal to cost of good manufacturer. Okay, so how are you gonna go about here? Look how in terms of the cost of goods sold, the cost is added to the available beginning finished good inventory. The cost of goods sold available for sale, the ending finished good inventory is deducted from this figure. It arrives as the cost of goods sold. So this is the logic here. The cost of good manufactured all the way going into the finished goods side in terms of calculation there. Okay. Now look at the example here, concept check 1, which is the example calculation. Raw materials inventory was 22,000 during the month of during the month 276,000 of raw materials was purchased. Account the end amount revealed 28,000 raw material was still present. What is the cost of direct material use? Okay, there's a selection of A to D. So what is the answer for this? All right, let's look at this logic. Give a second thought or a couple of thoughts or 1 or 2, 3 seconds. Okay, this is the answer for these questions. Okay, this is the C. So you got the beginning here 32,000 here. Where is it coming from here? Raw material purchase 276. Where is it coming from here? 276. And then you got available using production. Combine these two, become 308,000. And you got the ending of 28,000 here. So the raw material used in production is 280,000. That's how you get this number, okay? 280,000. That's how you get. These are the steps. Beginning plus purchase equal to available production minus ending. So you got this number, okay? All right. Let's look at the next one. Direct use in production total 280,000, okay? 280,000. Direct labor is 375,000. And 180,000 of management overhead was added to the production for the month. Was added to the month. What would total cost you can do in the month? Let's look at this logic and pause for a couple of seconds, get you the answers. You got the direct materials 280,000 here, plus direct labor is 1075,000 here, manufacturing overhead 180,000 here. Right? You got it coming from? Here's 280 coming from here, labor is coming from here, coming from here, 180 is coming from here. So your total overhead is 108.35. That's how you get this number, okay? All right, let's look at the number 3. Beginning work in process, 125,000. Manufacturing was added cost, 35,000. There were 1,200,000 partial finished good remaining in the work and processing. What is the cost of good manufacturing the month? Pause a couple of seconds to get you the answers, okay? All right. This is the way of getting the numbers. You got the beginning, 125,000 is here, coming from here. Manufacturing cost incurred for the period is 108.35,000. You got it coming from here. You add all of that, become total work in process is 160,000, but you got an initially ending inventory 200,000. You got here. So cost of good manufacturing 760,000. That's how you get this number. Okay, 760. Step by step, all the numbers there. Okay. All right. Look at the next step, which is being finished good inventory was 130,000. The cost of good manufacture for the month is 760,000. And the ending finished good inventory 150,000. What was the cost of goods sold for the month? So let's take a couple of minutes, a couple of seconds to answer these questions. So the answer will be, look at this, 130 coming from here, 760 is coming here, total is 190. Okay, you get all this, and you got a finished good 150. So once you get this number, 180, you move minus 150, you got 740. So what was the cost of goods sold for the month? Okay, that's how you get that number. Okay, step by step. 130 is from the beginning, cost of manufacturing 170. This is what is available, and then the finished good inventory ending is 150. 190 minus 150, you got 740,000. Okay. Number 4, objective number 4, called compute the underapplied and overapplied and prepare journal entry for this. Okay, so the difference between process, there's a couple of them. Underapplied overhead means it exists when the amount of overhead applied to jobs during a period using a predetermined period, using the predetermined overhead that is less than, this key is less than the total amount of overhead of actually incurred period. For this is called underapplied. Which is more than, which is greater than, that's called overhead. So that's the simple is a two different opposing line. Underapplied means less than, overapplied means greater than. Okay. All right, let's look at the next one. Overhead applications. PERCO actual overhead for the year is 150,000. Total work is 170,000. Direct labor hours work. So how you gonna determine overhead? That is $4 per direct labor. So how you gonna do that? 640 divided by 160. So you got the LH, direct labor head. Okay, direct labor overhead. Okay. So how are you going to apply this? Apply overhead, which is apply overhead during period times actual direct labor hours. So you got the $4, okay, times 170. So you got 680 there. Okay. So PeerCo actual overhead for the years was 650,000 with a total 170 direct labor hour work on the job. But PeerCo has a predetermined overhead that is $4 per direct labor. So they have a predetermined numbers. How do they get this number, $4? From the previous work. 640 divided by 160. So once you get that number, you can just multiply the applied overheads 4 times 170. Where you got the 4 come? From here. Where you got 170 is from here. So this is the number. Okay? Once you get the number, then the difference between 600 and 650, the next one. Here is the difference. Okay? The actual overhead 650. What is apply 680. So what is it? What happens here? There's an over apply of 30,000. What will the PeerCo do? Okay? What will the peer? There's an overhead applied by 30,000. When there's an overhead by 30,000, what you're gonna do? You're gonna apply underplay. So you're gonna multiply $4. Concept check here. Okay? I'm gonna go back here to make sure you understand here. Tiger, the example here. Tiger had actual manufacturing overhead cost a dollar, 1.2 $1.21 million. To pre overhead $4 per machine hours. Tiger worked for 290 machine hours during the period. What is the Tiger machine overhead cost? So we're gonna look at this manufacturer per step. $4 times 290, you got 1.160. Okay, this is the overhead applied. The under apply, which is 1.21 here, minus 1.160, so you got that's 50,000 under applied. Okay, so that's just the step. Let's go back here step by step because sometimes it can be confusing, right? I'm gonna go back here. Overhead is $4 times 290. Where you got the $4 coming from? This is the apply what the predetermined before, okay? And then 290 is the hours that work. So you got overhead applied 1.16 million. But it is under applied. How are you going to do that? How are you going to calculate 1.21? This is the actual minus is applied. So it's 50,000 under apply. Okay. Okay. Any remaining balance manufacturing overhead cost, such as PeerCo 30,000 of overhead, is disposed in one of two ways. It can be closed to CGS or it can be closed properly to work in process. So there's an overhead over applied. Two ways you can do is by number one, by closing to the cost of goods sold CGS, or it can be closed proportionally to work in process, finished good, or CGS. So how are you going to look at the T count? This is how you do it. Okay, cost of goods sold from 30 here, overhead there. Okay, calculating the allocation of underapplied overhead between work in process and finished good and cost of goods sold. Assume that the overhead applied in ending work in process, ending finished good, inventory and cost of goods sold is 68, 204, 408,000 respectively. Total value is 680. So in this case, how are you going to do that? Ending inventory will be 68,000 divided by 680. So you got a 10% here. And the finished good inventory with 204 divided 680 equal to 30%. Cost of goods sold will be 408,000 divided 680 equal to 60%. So when you do that, the allocations will be applied like this. Okay, allocations of 30,000 apply percentage basis. All right, that's how you do that step, percentage basis. So how are you going to look at the amount of percentage? How are you going to book it? Manufacturing debit is 30,000. Work in process credit 3,000. Finished good inventory 9,000. Credit cost of goods sold is 18,000. Okay. And then look at the next one. In summary, there are two methods for disposing under applied or overhead. Is number two, allocating between work in process, finished good, and cost of goods sold. The later method is considered more accurate, but it's more complex to compute. So you see, this is the key that I just showed to you previously. It's more complex to calculate. Next one. If overhead concept number 6, right? If overhead is closed out to cost of goods sold, what is the effect of net operating income? What is the effect? So the effect will be A. Why? The journal entry will include the debit of managing overhead cost and a credit to the cost of goods sold. And the decrease of the cost of goods sold will increase the net operating income. That is basically the end of this chapter. Okay, so guys, it's a little bit complex. If you go over again some of the materials of this video, okay, and also I put this in Edpuzzle so you can review in my Edpuzzle. All right, thank you everyone for seeing this video. I'll see you in the next chapter. Bye bye.